So markets have obviously accelerated since the last time we touched base on Wednesday evening. And on Wednesday evening, we were going through a case for why, from a fundamental standpoint, the S&P 500 is only worth about 4,500. That video is still there. But, more importantly, what I'm going to try to do here is go through and really take a look at some indicators and things of that nature to try to figure out, where we are, whether or not really 4,500 is doable from a technical perspective. Also, please remember to subscribe to this channel, like this video, share it with your friends. Let's please try to get it trending. I'm still looking to grow my channel out to 50,000 followers this year in 2025. So I appreciate your support and thank you for watching. And, what was interesting today about this movement was that, number one, we talked about the 5,200 level being a key level. And, basically once we broke the 5,400 region, I thought we could get a pretty quick drop to 5,200. I've been writing about it in my free blogs that I post in the community section every night. And we had talked about it, I think, in the video even on Wednesday. So we broke 5,400 at the end of the day on Thursday. And by basically 9:42 this morning, you were trading basically at 52.09. So we were there in 12 minutes. And the interesting thing about today also is, if we'll take one more other look, when the market is kind of in the middle of these types of processes, it often looks back to and it tries to find, some sort of important low, and it tries to kind of probe that level for a while to see how that's going to hold. So 51.23 stands out to that important level, which was the August low. And so if we go back and we again look at the closer view of it, you can see that 51, this region really kind of was being tested all morning long. And then basically after 2 o'clock, when margin calls start rolling in, it broke. We kind of came back up to it, tested it again, and we saw a really big decline. There was about $5 billion for sale on the market on close, and that's quite a big amount. And so that's why we saw that sort of last, big move down into the end of the day. The saying is that markets typically don't bottom on Fridays. I don't know where that saying came from, and I don't know that I necessarily believe it, because I've certainly seen, plenty of markets kind of open up and turn the next day. The low actually in October of 23, I think, stands out to me as one of those moments. We can actually go back and check really quickly while we're doing this. I think that would be fun. So this is October of 2023. If memory serves me correctly, this was Friday, October 27th, and then we opened higher on Monday, and the market took off. So when people tell you that the market doesn't usually bottom on a Friday, you might want to just kind of do your homework on that. But in the meantime, what we're also kind of looking at here now is that this level is broken. This is probably going to become some sort of level of resistance. Now, granted, I don't know what's going to happen between tonight and Sunday evening when the futures open again, and what President Trump is going to be pushing out there on Truth Social or Twitter or whatever media platform he's deciding to use. And I really don't know his schedule and itinerary either. So a lot of things can clearly change between now and then. I'll also point out that I'm just realizing this now, is that here you have a gap that was basically filled also from May 2nd, 2024, and that was basically filled at the very end of the day. There's plenty of other open gaps that you could start looking at and making cases for on the way down. In fact, the one around 4,400 certainly stands out as well, when we had a nearly 2% rally following Tuesday, 14th of November, probably around the time of a CPI report. Usually the CPI reports come around the 10th to the 15th of the month. So that would make sense. So right now we're kind of just thinking about whether or not, what this drop may mean. So at this point, from a technical perspective, this is sort of one area where you could maybe start to think about where there could be some support in the market. And clearly a break of that level starts opening the door, I think, to lower levels. And like I said, 4,500 from a fair value standpoint certainly begins to make sense. I know people look at the RSI and say the market's oversold, and you look at the Bollinger Band and the market's oversold. And usually those two things, in my book, usually mean you're either due for some sort of bounce or some sort of sideways consolidation. Unfortunately, I don't really know if those rules apply right now, just because of the type of velocity and movement we are seeing. I mean, so the VIX right now is up at about 45, and people will look at that and say, "Oh, the VIX is high, the market's capitulating." Maybe, right? I mean, I don't know if in isolation that really is the best way to think about it. I like to look at the VIX to VVIX to kind of give me a sense of things, and so clearly when you look at the VIX to VVIX ratio, I don't know why I like to use this, but it just seems to make sense to me, and I think we always need to try to use indicators and things that make sense to us that we can use as a guide. And what this kind of implies to me is that we can still probably see this go a little bit higher. In fact, this peaked in October of 22, which of course marked the stock market low. When we look at implied correlations, 1 month implied correlations right now around 46. You can certainly see during all of these different periods of time in 22, we were much closer to like 55. Certainly in 2020, we got up to around 87. And if you just go back and you look over the course of history, you can certainly see, implied correlations were typically much, much higher. Here's October and November of 2008. We were up here at 96. This is 2011. We were at 95. So implied correlations typically go towards 1, and things become more correlated as the market begins to go down. So it doesn't really look to me like implied correlations, at least on the 1 month level, have gotten to that point yet. When we look at the 3 month implied correlations, those are also kind of still low, also suggesting that maybe there's still a little bit further to go here. The other thing that I've been watching as well are these BTIC adjusted interest rate S&P 500 total return futures. And you can see how this has just totally collapsed. It's down to 50. Remember, at one point we were doing videos back in December talking about how these readings were up, at much, much higher levels. And in fact, you can see here we got all the way up to 180. And really what this is telling you is that the cost of financing for equities has really plummeted. And right now there's not a lot of interest to go out and lever up. And that's for obvious reason. The other things that we can really look at are credit spreads. CDX high yield credit spread index at 440 today. Again, this is where we were in October of 23. Remember, we just went back and looked at that. It was at 530. We got to a high of 623 in September of 22. We can certainly go back and look at some other periods of time. Here's February of 2016, 590. Here's December of 18. We were up here at around 480, 490. So again, this seems like a little bit too low to me to suggest that we're seeing some sort of capitulatory bottom yet. If we continue to kind of go around the world of, swaps and credit spreads and things of that nature, here's your Japanese yen 5-year cross-currency basis swap spread. And this right now is at negative 51. If you just take this and invert this looks identical to credit spreads, high yield credit spreads. And so again, what this is telling you that they're widening out, right? And essentially what you're seeing here is, again, suggesting that probably these swap spreads can continue to rise. And when you look at it also from a 5-year euro basis, when you look at it from a euro cross-currency basis swap spread, it's also a very similar look. This is also inverted. So if we just push it back to the regular look, you can see, we were all the way over here in October of 24. So conditions, there was a lot of liquidity, I guess, coming into the market. As these are falling, think about that as a sign of liquidity conditions tightening. When you see people talking about how the dollar is weakening and this is great for financial conditions, they're helping to ease, and 10-year rates are falling and that's easing. Well, credit spreads are telling you something completely different. And what they're telling you is that financial conditions are actually tightening. And right now, usually, when you kind of look at how financial conditions are stacked, if you look at the Chicago Fed's website, spreads really kind of have a little bit of a bigger weighting. Certainly the Chicago Fed Financial Conditions Index looks a lot more like a credit spread index, like the one I'm just showing you, than it does like the 10-year rate. So I would be a little bit wary if you start reading about how financial conditions are easing, or financial conditions are going to be easing because the dollar is getting weaker. Again, these play a part, but they're not the only part. And if we kind of just use a basic metric here for what a credit spread may look like, what I use is I basically take the SHY and I divide it by the HYG. And you can see that the financial conditions index trades almost perfectly with credit spreads. So basically, if you're reading about how financial conditions are going to be getting easier because 10-year rates are falling, and because the dollar is falling, and that means more liquidity, and that's good for global M2, that's probably not completely correct. I would do a little more work on your own regarding that. So what this is also implying to me is that, again, we can probably see financial conditions tighten more. We can probably see credit spreads widen out more. We're probably not at a breaking point yet where we've seen the ultimate sort of capitulatory bottom. And so I think given some of these factors, what we're kind of left with is a market that, probably could continue to decline a little bit further. I think that there's probably some more to go. It doesn't mean it's all going to happen on Monday, hopefully not. And it doesn't mean it's going to happen next week. I think it's going to be largely dependent upon how this tariff stuff continues to play out. And if the tariff stuff is really, sort of Trump's agenda and he's hard locked on it and he's not going to budge, then the market's going to continue to do what it does until it breaks someone, whether it be Jay Powell and he cuts, or whether it be Donald Trump and he caves on his tariffs. It doesn't seem to me, at least at this point, that Jay Powell, who just happened to speak today, isn't really in a rush to cut. And it doesn't really seem like Donald Trump, who was out playing golf most of today from what I read, is really interested in changing his tariff policy. And so, if that's the case, then we may continue to see more market probing until it finds that bottom. Anyway, that's all we're going to have for tonight. If I have more stuff to talk about over the weekend, I'll put out my usual Saturday video. If not, you may not hear from me again until the start of next week, unless you're in the membership area. Otherwise, have a great weekend. Please remember to subscribe to this channel, like this video, share it with your friends, and we'll see you soon. Bye.